The US federal government has an average debt duration of around 6 years, but much of that is concentrated in shorter term instruments like T bills, with the rest extending up to 30 years. As interest rates were hiked and maintained at high levels, a significant portion of this debt was refinanced at these higher rates. This increased interest expense has led to larger deficits, which paradoxically provide a stimulatory effect on the economy, offsetting some of the impact of higher rates on the private sector in comparison to the global situation in the US. Has been relatively resilient to rate hikes. Initially, I expected the government to face challenges from this duration mismatch sooner than it did. By early 2023, it became clear that the impact of this mismatch was more significant and accelerated faster than anticipated, prompting me to shift my focus toward the theme of fiscal dominance.
The U.S. federal government's debt portfolio has an average duration of about 6 years, but this figure can be misleading due to the significant concentration in shorter-term instruments like Treasury bills, which are typically issued with maturities ranging from a few months to a few months to a few years. The remainder extends up to 30 years. This structure means that, in practice, a substantial portion of the debt is subject to refinancing within a relatively short time frame, particularly during periods of rising interest rates. When the Federal Reserve hiked rates and kept them elevated, a large portion of this short-term debt was refinanced at these higher rates. As a result, the government faced increased interest expenses, leading to larger budget deficits. These deficits, while adding to the overall debt burden, also have a stimulatory effect on the economy by injecting more money into circulation. This counteracts some of the restrictive impacts of higher rates on the private sector, making the U.S. economy somewhat more resilient to rate hikes compared to other regions. Reflecting on the situation from 2022, I anticipated that the government would encounter significant challenges from this duration mismatch earlier than it actually did. By early 2023, it became evident that the effects of this mismatch were more pronounced and accelerated more quickly than I had initially forecasted. This realization led me to adjust my perspective and focus more on the theme of fiscal dominance, recognizing that the government's fiscal policies and debt dynamics were having a more substantial and immediate impact on the economic landscape than previously expected.
Subscribe our channel and press the bell button to get our video notification. And like the video.
We first observed signs of fiscal dominance around 2017, with a more pronounced trend by 2018 and 2019. In the early part of 2023 and late 2022, we saw a renewed phase of fiscal dominance. Fiscal dominance can fluctuate, meaning a country might shift in and out of this state depending on economic conditions. Fiscal dominance is typically characterized by large structural deficits. However, I quantify it by comparing annual deficits to private sector debt issuance. Specifically, I look at net bank loans and net corporate bond issuance. If the combined total of private sector debt issuance is less than the fiscal deficit for that year, it indicates a scenario of fiscal dominance. This approach helps gauge the relative impact of government deficits compared to private sector borrowing and debt issuance.
We started observing indications of fiscal dominance around 2017, with a clearer trend emerging by 2018 and 2019. By the early part of 2023 and late 2022, we re-entered a period of fiscal dominance. Fiscal dominance isn't a static condition, it can shift based on economic dynamics. You can be on the verge of fiscal dominance and then move in and out of it depending on fiscal policies and economic conditions. Fiscal dominance is commonly associated with large structural deficits. However, my approach to quantifying it involves comparing these annual deficits to private sector debt issuance. Specifically, I analyze net bank loans and net corporate bond issuance for a given year. If the total amount of private sector debt issuance comprising both bank loans and corporate bonds is smaller than the fiscal deficit for that period, it indicates a state of fiscal dominance. This comparison helps to understand the relative impact of government deficits in the context of private sector borrowing. When government deficits exceed the sum of private sector debt issuance, It suggests that fiscal policy is having a dominant effect on the economy, potentially crowding out private sector borrowing and influencing economic conditions more significantly.
How many countries back their currencies with gold? They issue currency against their gold reserves, either directly backing it or using gold as a source of confidence. If a currency started to weaken, countries could sell some of their gold to buy back their currency, stabilizing its value. In the modern era, U.S. Treasury securities have largely replaced gold as the core of the reserve asset system. However, a range of assets can serve as reserve assets, including various currencies, bonds, stocks, and gold. While most of these assets are highly liquid, gold can be less so, depending on its storage and disposal logistics. This system allows countries to protect their currencies during periods of weakness. Countries can also engage in mercantilist policies to keep their currencies weak, intentionally giving them a competitive edge in manufacturing. For instance, if the dollar is weakening and a country is running a current account surplus, causing its currency to strengthen, that country might print more of its currency. They would then use this newly created currency to purchase foreign assets like treasuries, stocks, or gold.
Countries used gold as a cornerstone of their reserve asset systems. They issued currency backed by gold, either directly pegging it or using gold reserves as a source of strength. If a currency weakened, countries could sell some of their gold to buy back their currency, thus supporting its value and stabilizing their monetary system. In the modern era, U.S. Treasury securities have largely replaced gold as the central element of reserve assets. However, various types of assets can serve as reserve assets today, including different currencies, bonds, stocks, and gold. While most of these assets are liquid and can be easily converted into cash, gold can be less so, depending on its storage and the logistics of disposal. Despite this, these reserve assets help countries protect their currencies during times of economic weakness. Countries can also implement mercantilist policies to intentionally keep their currencies weaker, which can be advantageous for their manufacturing sectors. For example, if the dollar is weakening and a country is experiencing a current account surplus leading to a strengthening of its own currency, the country might choose to print more of its currency. They would then use this newly created money to buy foreign assets such as treasuries, stocks, or gold. This strategy helps to suppress the appreciation of their currency and maintain its competitive edge. This approach can have implications beyond currency valuation. By keeping their currency weaker, countries may limit domestic savings and wages, concentrating economic benefits at the national level and affecting workers' purchasing power. This mercantilist strategy helps countries manage their economic positioning on the global stage, often at the expense of broader domestic economic factors.
Subscribe our channel and press the bell button to get our video notification. And like the video.